We all know the importance of gold in our portfolios, especially in times when stock markets go south. But many people have asked us what really is the best way to invest in gold. Welcome to Upsurge, where we'll discuss all about investing and trading. So let's hop on to discuss 5 methods of investing in gold, starting with physical gold. Physical gold comprises jewelry, gold coins, bars and biscuits. As Indians, it runs in our DNA to purchase jewelry for festivities, thinking it to be an investment. But buying physical gold may not be the best option if your purpose is only investment, as you witness additional charges, difficulty in storage, loss in the time of distress sale, etc. So in the past few decades, a lot of things have digitized, and so has the mechanism through which you can invest in gold. That's why not discussing digital gold as an investment option would be a little unfair. Digital gold, as the name suggests, is one of the easiest ways to invest in the commodity. You can start from as low as rupee 1 by making digital transactions on gold at market prices and redeeming it when you want to sell. To give you a perspective on the price movement, digital gold is backed by actual physical gold, as these platforms tie up with traders and gold manufacturers. Again, this definitely sounds like a good option to make the investment, but still might not be the best one from the perspective of taxation, both direct and indirect, and some additional costs like spare costs attached to it. This indeed drags down your net return to some extent. So before I discuss the next method to invest in gold, I would like to discuss what ETFs are. They are nothing but a basket of securities which tracks the performance of a particular security or a basket of securities. Some ETFs track indices, while some ETFs track the performance of gold. The reason why we can go for gold ETFs is that it has a lower cost of acquisition, as there are no making charges and other related expenses. But there are 2 disadvantages of investing in gold through ETFs. Number 1, ETFs have a fund management fee which reduces the net return by a bit. Number 2, brokerage might be involved while buying and selling ETFs. These drawbacks are applicable to gold mutual funds as well. So now what do we do? Well, if your time horizon is as long as 5 to 8 years, investing in gold through SGBs might be a better option. Sovereign gold bonds are government-backed gold bonds, and they have some distinct features which are not available in other forms of gold investments. So when you buy and sell jewelry, there is a loss of 15 to 20% in making charges each time you change the form of gold. So SGBs are definitely cost effective, and not just vis-a-vis physical gold but ETFs too. The reason why we lay our emphasis on SGBs is that they pay you a 2.5% interest on your holdings. The other methods just give you the price appreciation that the commodity goes through and not this additional 2.5%. Moreover, these interest payments are less subject to market risk as they are backed by the government. Oh, and since there is government backing, they also come with certain tax benefits. For instance, capital gains on SGBs are tax exempt given you hold the bond for the entire tenure, that is 8 years. However, the interest earned is taxable in the hands of the investor. SGBs also come in with a lock-in period of 5 years, only post which they can be traded in the secondary markets. And this is where ETFs win over SGBs in terms of the lock-in period, because you can trade ETFs as and when you want on the exchange. Now, as I mentioned earlier, it is not imperative to invest in gold, but it has been seen as a safe haven during any economic, geopolitical or financial crisis. However, any decision to invest in gold has to be taken by keeping in mind the overall portfolio mix and long-term goal. Normally, an exposure of 8 to 12% gold in the portfolio may be ideal to give the safety net to your portfolio in uncertain times. We can narrow down 2 options for investing in gold now. Number 1, if your investment horizon is 5 to 8 years, go for SGBs. Number 2, if you have a shorter investment horizon, gold ETFs might be more attractive to you. But remember, this is only from the perspective of investments in gold and not jewelry making per se. So hope we answered a few of your questions here. And we hope you share this video with your friends so that the YouTube algorithm works in our favor. See you.